you for watching my videos. In this video, we're going to learn how to read charts. In the Forex market, we will come across several types of charts. But for now, I'm going to show you three types of charts: the line chart, the bar chart, and the candlestick chart. So here we have a line connecting a series of dots. These dots represent the closing volumes of each trading period. Now, when we invest in the Forex market, we need more information than just the closing volume. The closing volume is not enough to give us good technical analysis. So, I'm going to show you a different type of chart. Now, the bar chart, instead of lines, we have bodies. And these bodies can tell us where the market opened, closed, and what the high volume and low volume was for that day. And the bodies are easier to read and we get more information. So let's look at how a bar chart appears. This looks a lot different from the line charts. As you can see, we have bodies instead of lines. Now, here's a close-up look at one of these bodies. Here we have a vertical line with two horizontal lines attached to the vertical line. The top of the line is the high for the day. The bottom is the low for that trading period or trading day, depending on what chart you're looking at. The horizontal line to the left tells us where the market opened, and the horizontal line to the right tells us where the market closed. So this gives us more information than the line chart. However, technical analysis is not enough. As we learned from the previous video, we need to use technical, fundamental, and sentiment analysis. We need to look at a chart that gives us more than just technical analysis, including a little bit of fundamental and sentiment analysis. So let's look at the candlestick chart. The candlestick chart was developed in the 16th century by Japanese rice traders who wanted to study the value of their rice during each trading session. Today, this is the most popular way of studying the moves on the Forex market as well as the stock market. So let's take a moment to familiarize ourselves, if we're not familiar already, with Japanese candlesticks. So, how to read a candlestick? Well, we have two candles, a white candle and a black candle. The white candle on the left tells us the opening volume, the closing volume, and the high and the low. So, the rectangular area, that is called the body. And the two lines sticking from the top and bottom of the bodies, those are called wicks. And on here, these wicks symbolize the shadows of the bodies. Now, on top of the wick tells us the high for the day. Just like on the bar chart, the top part of the vertical line tells us how high the volume was during that session. On the bottom of the wick, the lower shadow tells us how low the price reached during that trading session. Now let's look at the body. The top part of the body tells us where the market closed at the end of the session, and the bottom part of the body tells us where the market opened in the beginning of the session. The black body, the numbers are the words are the same. So we have the high and we have the low. The high on top of the wick and the low on the bottom of the wick. The only difference with the black shadow is that the top part of the body tells us where the market opened in the beginning of the day, and the bottom part of the body tells us where the market closed at the end of the trading session. So we can say that the white candle symbolizes the bull market and the black candle symbolizes the bear market. We don't have to use specific colors when we trade on the Forex market. However, it is very common to use green to symbolize the bull market and red to symbolize the bear market. So keep that in mind as we look at many charts throughout these videos. So again, green means the price went up. Red, the price went down. So let's take a look at the candlestick chart. So here we have a third chart, which is the candlestick chart. It looks different from the line chart and slightly different from the bar chart, only because the candles are too small to see. So I took one of the candles, I blew up the size, and here we can see in this trading session, the market opened at this price down here and rose significantly. However, the sellers, the bears, came into this market to push the prices down. But there was some resistance from the bulls, and the bulls raised the price. So this long candle tells us that there was a lot of volatility during this session, and there were many conflicts between the bulls and the bears. From here, we can see that the sellers were really strong during the trading session, and they were able to push the volume down, but the bulls remained strong to push the volume up. So let's talk more about support and resistance. I gave you an introduction to support and resistance in the previous video, and I did tell you that I would give you more information in this video. So here's what we need to know about support and resistance. So here's another line chart, and notice how the movement of the market stays between the support and the resistance. Interesting, isn't it? Now, when the market is stable, the candlesticks are more likely to stay between the lines of support and resistance. Only when it's volatile, the lines can be broken. Now, if the support line is broken in a bull market, that also signals that a trend may be reversing and the bull market will become a bear market. And vice versa, when the line of resistance is broken in a bear market, that means that the trend might reverse and we might have a bull market. Now, keep this in mind. Support and resistance, they're not exact numbers. Lines do get tested, lines do get broken. So sometimes it's more beneficial to think of support and resistance as zones instead of lines. So again, I'm going to show you a line of support. Notice that in this first circle right here, one of the wicks from the candles pierced through the line of support, but it retraced and gravitated more towards the line of resistance or more towards the middle. And also in this second circle, there was another attempt to pierce through that line of support, but the support line held. And a third attempt to pierce through that line of support, and again, it held. So 3 times this market hit the line of support, and all 3 times it bounced away. Now, there is no definite way of determining whether or not a bear market or a bull market will end. So we need more information than just support and resistance. We can't just rely on one position. We need to study all 3 analyses together and use that information coupled with the line of support and resistance to give us the information that we need. So let me give you an example of a support and resistance zone, as I mentioned previously. So here the market seems to be going sideways in the beginning. However, volatility picked up and the line of resistance was broken. However, we placed a second line of resistance, and that second line held and pushed the volume down. And then it went back into this original range until volatility picked up. The bear stepped in to push down the volume past the initial line of support. However, there was a second line of support to push the volume back up to give the bulls more momentum to keep the market in range. So, support and resistance, they can be lines or they can be zones. And more examples of support and resistance as to how strong they can be and how weak they can be. So here, throughout this chart, we see strong resistance and we see weak resistance. Also, we see strong support and weak support throughout this chart. So there really is no way of determining where to open a position based on reading support and resistance alone. However, support and resistance is a good way of guiding us and giving us an idea as to where a good place might be when we decide to open a position. Now, how to draw trend lines. On your trading platform, you should be able to draw lines on your charts. Drawing lines on your charts is very beneficial to determine where to enter a position. So, and also keep this in mind, in order for trend lines to help us, we have to draw them correctly. If we don't draw them correctly, then they will fail us. So, there are three types of trends. The uptrend, that's what we see in the bull market. Downtrend, that's what we see in the bear market. And sideways, it just means there's little volatility and the market is stable. So, and let's examine these three types of trends in this chart here. So, we have our uptrend. How do we make an uptrend? Well, first, you start with the first candle that began the bull market, and you examine the last candle in that uptrend. And then you connect the opening volume. Do not connect the lows. Many traders make this mistake by connecting the lows of the candles. Don't connect the lows. Connect the opening prices only. Start with the first candle and connect the last candle. And as we can see, the line of support was hit once, twice, 3 times, 4 times before the support broke and the bear market took over. So remember, do not connect the lows, connect the opening prices only. That's how we read an uptrend. For bear markets, how do we draw a downtrend? It's the opposite. Start with the first candle that began the bear market. And that would be, begin from the opening price of that first candle down to the last candle of the downtrend. And remember, connect the opening prices only, do not connect the highs, or else you will not get the reading that you need. So connect opening prices only. And by connecting the opening prices, we can see that the line of resistance was tested once. Well, here it was really tested, but the line of resistance held its place. So it was tested once, twice, and then it finally broke and the bulls took over. So as we can see, when we draw our trend lines right, we have a good idea as to where to go long or go short. Now, sideways trends. We draw 2 lines and they must be parallel, no exceptions. To draw the top line, we take the first candle that began the sideways trend with the last candle, and we connect the opening, or closing volume, or the top part of the bodies. Not the top part of the wicks, but the top part of the bodies. And we do the same for the bottom. We connect the opening and closing, or the top part of the, the bottom parts of the bodies, but not the wicks. And that's how we get our sideways trend. And notice that in this trend, the bodies stay between the lines. Now, the lines were tested, but the volumes did remain inside the lines, as we can see here. Now, here are some things to remember when we are examining trends. We need to know that it takes 2 tops or 2 bottoms to validate a trend. However, we need at least 3 tops and 3 bottoms to confirm a trend. The steeper the trend line, the less reliable it is. And like horizontal support and resistance, trend lines are the strongest when tested. If the volume bounces off the support line many times, that will tell us that the bull market will continue or may continue. I shouldn't say will, because there's no guarantees in this market. Now, on the line of resistance, if the line of resistance has been tested numerous times, that means the bear market is likely to continue. And this is also very important. When we draw our trend lines, some new investors are so desperate to open a position that sometimes we force the trend lines to fit in the candles. No, never force the candles into the trend lines. If the candles don't fit, then it's not a real trend. So don't get desperate. Now, what are channels? Channels are also important, and I'm going to show you how to make a channel. So to draw an up channel, or a channel in the bull market, first we draw the uptrend. And just like before, we connect the rising lows. And then we make a parallel line. Now, on your trading platform, you do have the option of drawing parallel lines. So it's more likely that you're not going to make your own parallel line, but your software program will be able to assist you in making the parallel lines. So after we draw the uptrend, what we do is we select the option of creating a second line, which is parallel to the uptrend, and we place this at the position of its most recent peak. Now, if we look here we have our uptrend. Now, right here, we're looking for the most recent peak, which is right around here, and this is where we place our line. Now, if you notice, in this trend right here, these candlesticks, they stay within this channel. Now, the line of support was hit once, twice, 3 times, 4 times. And the line of resistance was hit once, twice. It almost hit this 3rd time. But here it was tested. So almost 5 times the line of resistance was hit. So this is a really strong channel. So if you're the type of person that's looking to go long in a bull market, it's highly recommended that this level right here would be a good place to go long. Now, to make a down channel, well, the same rules apply for making the up channel. So we start with the downtrend line. So we're right over here, and you should know by now how to make a downtrend line. And you should also know by now that your trading platform will assist you in making a parallel line. We do that, and we connect the parallel line at the position where it touches the most recent valley. So it's just like the up channel where we look for the most recent peak. Now we're looking for the most recent valley. And the same process also goes for ranging channels. We're just looking for the most recent peak and the most recent valley, and the lines must be parallel. Now, again, there are 3 types of channels. We have the ascending channel. As we can see, this market is moving. between the lines of support and resistance. Then we have the descending channel. Again, these candles are inside, well inside the lines of support and resistance. And the ranging channel, as we saw before. So, here is what we must remember when we are studying trends. Trend lines must be parallel to each other. Now, this will probably not be an issue for us because our trading platforms will give us the tools to make parallel lines. So we don't have to make the lines parallel. The software program will make the lines parallel for us. Also, the bottom of the trend line is considered the buy zone, whereas the top of the channel is considered the sell zone. So it is common for many investors to look at a chart, and when the chart is testing the line of support and that line of support is holding strong, that tells us that we should buy this pair. And same thing with the line of resistance. If a line of resistance has been tested many times, but the line of resistance is keeping the prices down, that should tell us that we should sell. And just like in drawing trend lines, don't ever force the channels that you draw. So remember, we have to draw the lines properly and accurately. So don't get desperate when we're looking at trends. If the candlestick charts don't fit, it's not a real trend. Now, how to trade the lines. Now let's look at the bounce. So here the market is in a bearish trend. It hits the line of support, but it retracts from the support and goes the other way. What many investors will do at this point is that they will go long, because as we know, when support lines are being tested and held, it's more likely that the trend will continue. However, lines of support do break, so it is very important to minimize how much you lose by placing a stop loss order. So every time we open a position, always use your stop loss. And the bounce also works with lines of resistance. As we can see here, in the bull market, the market hits the line of resistance and it retracts. So what many investors will do is they will play the bounce. They will try and make some profit after the market hits the line of resistance and goes back the opposite way. So we can enter our position here, but again, lines of resistance do break, so we should also place a stop loss in order to minimize how much we lose. So that is called the bounce, when the market hits the line of support and resistance and goes the opposite. The break, however, is when that line is completely broken and a new trend is about to begin, or an old trend has ended. So here we have the line of support, which is completely breached. So many investors will use either their fundamental and sentiment analysis to determine, well, this could be the beginning of a new trend. So I'm going to enter the position right after the break. But just in case you're wrong, we put a stop loss right above the breach. Now, here is a conservative way of playing the break. So here's a scenario. You decide to short the euro-dollar pair, hoping that it would fall after the support level has been breached. But soon after, the market pulls back towards the initial line of support and you're losing money. So what do? Do you cut your losses, or do we stick with the trade and be patient? This is what happens when we hold on to our trade. And we're successful. As we see, the line of support was breached the first time and the market continues to fall. However, the bulls stepped in to push the price back up, and then the bears stepped in to continue that trend. So That's what happens when we're patient, and this is what happens when we use fundamental and sentiment analysis together with the technical analysis in order to determine that the market will continue its bearish trend. So support and resistance, that's a good strategy that we can add to our Forex tool belt. And in the upcoming videos, we're going to have many tools in our tool belts. Now, in summary, here's what we've learned in this video. We learned about support and resistance. We learned that support and resistance are more than just lines, they can be zones. And we also learned that lines of support and resistance are tested often. And depending on how strong these lines are and how well they hold, that gives us an idea as to how strong or weak the trend is. We also learned how to draw trend lines and how to draw them properly. And we also learned about channels and how candlesticks in a stable market tend to stay within the channels. In my next video, I'm going to teach you more about Japanese candlesticks and its significance in the Forex market. Thank you for watching this video, and good trading.